So today we're going to cover off a swift market update, a summary of UK economic data, and then our take on what it all means. Firstly, on markets, the FTSE 100 index has traded sideways around the 7,000 level over the last few weeks. More notably, the bond market has sold off, bond yields have risen, 10-year gilt yields have jumped from 70 basis points to 1.1% over the course of the last month. This has come on the back of rising US Treasury yields and increased inflation expectations on the back of a weaker currency. And this will take us very neatly into the next section on UK economic data. We had 3 bits of UK economic data this week: inflation, jobs, and retail sales. Firstly, on inflation, inflation almost doubled to 1% in September from August, which is the highest level that we've seen in almost 2 years. We think that inflation is going to rise in the course of the next year, and it will probably breach the Bank of England's 2% inflation target sometime in the first half of 2017. This comes off the back of a weaker currency pass-through, as well as a recovery in oil prices. On the jobs front, the jobs data was good, it was solid, it showed few effects from the impact of the Brexit vote, nor should it have, because companies are largely not retrenching staff because they don't know what Brexit looks like. The other side of the coin is that they are not hiring actively. The jobs data also told us that wage growth has been fairly muted with few effects from inflation. Again, the flip side to that is that there is some erosion in our purchasing power. In terms of retail sales, growth fell to 4% from 6% previously. It's still a solid number. It's not recessionary. We want to watch this going forward because retailers will be juggling between passing through higher import prices and cutting their profit margins. In summary, the data tells us that this is not a demand-led inflationary environment. We're not in a position where the economy is growing, prices are rising, and wages are rising even more. What's happening is that the weakening in sterling comes up against slowing growth. It's good for FTSE 100 companies, not so great for the man on the street. On the back of that, we think that the Bank of England is going to remain on hold with regards to interest rates in the foreseeable future. Gilt yields at 1%, we think do not represent good value, particularly against the prospect of inflation rising to 2, maybe 3% next year. So we remain underweight gilts and we retain a preference for credit within our fixed income portfolios.